Hey, what's going on, my friends? It's your man Adam Ace Spencer here with another growth portfolio update. Yeah, things have not been going so well in the stock market, as we all know, especially with Friday's news, Powell and whatnot. The market pretty much tanked even more than what it has recently, and things aren't looking so hot, especially for growth and like tech plays. Ooh, we are getting hammered, as you guys will see with our portfolio. That, if you're new here, we contribute $25 every week to this portfolio. So if you're someone out there who's balling on a budget and you want to start to invest your money, get your money to grow for you for the long term, again, 3 years, 5 years, 10 years, 15 years, we're talking long term. Don't look at this like something that you are gonna, you know, throw a few dollars at it and it's all of a sudden gonna, grow into, $10,000 overnight. Definitely not going to happen. This is a small amount of money that we are contributing on a consistent basis, taking a dollar cost average approach. So that means when the economy or the market is good, it's up here, we're still contributing $25. And when it's down here and it's doing bad, we still contribute $25. That way we are averaging out and, continuing to buy shares when the market's high and low and getting us right there in the middle, hopefully. All of that said, as you guys can see, over the past day, we are down 3.75%. Over the past week, we're down 10.57%. Over the past month, we're down 27.9%. Over the past quarter, we're down 15.74%. And then 1 year and all time, our growth portfolio is down 48.87%, which gives us a current value of $977.02, which, our gain is negative $522.85 with, 4 pennies that we've received in dividends. Now, really quickly, before we go and see what stocks are performing well, who's not doing so hot, if anyone is even doing well, considering how badly this is looking right now, this is why I also have our dividend portfolio as well. So if you haven't seen that video from yesterday, check that out. You can see our dividend portfolio is doing much, much better than our growth portfolio, and rightfully so. When the market isn't doing well, when the economy is not doing so hot, growth plays are usually going to be hit before value plays and dividend plays. And the reason is because growth companies obviously aren't really as proven, aren't as solidified. And, these are more of a long-term play that you are hoping will grow in value over the years. So, if we had gotten behind Tesla, when it was at $10 or $50 or $100 or $200, and we were doing this, well, we would be sitting pretty nicely right about now, even though Tesla is kind of down over the past, few days and weeks and whatnot. We would still be doing really well because we started to buy and accumulate the shares at a cheap price when it was really cheap and just did it on a consistent basis. That's what we're doing with this portfolio, with these stocks. We're hopeful. We're optimistic. We believe that, ChargePoint in 10 years from now, when when electric vehicles are all over the place and people need to charge their car instead of going to the gas station. Yeah, I mean, gas stations going to exist, but they'll probably have charging stations at all of them more frequently than what we currently see now. Well, the belief is that ChargePoint will be worth a lot more money in 5 years from now, in 10 years from now, 15 and 20 years from now. Of course, we don't know if they will, right? They're pretty popular. They are, I would say, the most popular charging station in the country. But things happen, things change. And maybe, over the next 5-10 years, they become the second or third most popular and someone else becomes, more prominent. And, they end up passing ChargePoint, but maybe ChargePoint's, stock price in 10 years goes up $20 or $5 or $3 or whatever it is. Well, we were able to benefit because we have been accumulating shares this whole time. So looking inside of our portfolio to see who is doing well, ChargePoint is the only stock that is in the green, where you can see we're up 6.79%. Unfortunately, after that, you got CleanSpark down 10.65%. Navita down 17.89%. SEMrush down 39.51%. Backed Holdings down 39.74%. Fuel Cell Energy down 44.75%. Palantir down 48.33%. Coinbase down 61.76%. And then DraftKings down 69.29%. Brutal. Ooh. Now, like I said, I'm not, panicking. I'm not freaking out like some people might, for multiple reasons. One, I mean, yes, we're contributing a small amount on a consistent basis. So, this portfolio as a whole, even if it was if we were in the green and we weren't down 48%, at most this would be 1,500 basically. Not at most, but from the net cash flow, how much I contributed. And, that's a lot of money, especially if you're balling on a budget, but it's not too much. We can be down worse. There are people down hundreds and thousands of dollars and millions, with this current market. Bill Ackman had sold Netflix for a loss of I think he said $400 million or something. Of course, these are, bigger players and whales that got hundreds and thousands and millions of dollars. But the point is, it could be worse. It could be much, much worse. And the other aspect of this is that, this is, again, a growth portfolio. This is something for the long term. So what we're seeing right now really doesn't matter, because in 5 years from now, and 10 years from now, and 15 years from now, we will likely be, the market as a whole, stocks, the average, company out there right now will likely be higher in its stock price and its value. That's the hope. That's a belief. That's, of course, nothing I say is legal or financial advice. And every company in here could be down even more in 10 years. Very unlikely, but it's possible, especially if you don't do your proper due diligence, do your research, and, look up on the companies that you are investing in, that you're adding into your portfolio. Now, that said, one company I'm thinking about actually getting rid of, and, I've mentioned this months ago, haven't really brought it up recently, but I'm kind of reconsidering it now, is Fuel Cell Energy. And, there's a few different reasons why, but ultimately, I keep questioning that one stock and that one move and wondering, okay, I think it's going to go up. Question is, how high will it go up? Is it worth it? Are we going to miss out on other gains that will, see drastically increase how much we can get in returns compared to them maybe going up 3% or 5%? Whereas Palantir or Bakkt or these other companies, SEMrush, Navita, might go up 30, 40, 50, maybe higher, maybe not. But either way, this is the one move that I'm kind of starting to reconsider. I hate selling, especially when you're down at a loss. I mean, this is 2.5 weeks worth of contributions that we would miss out on, that we'd be losing and just, giving up, so that we can get this $96.40 and then put that among the current, stocks that we have in our portfolio. The other option is to consider bringing in another one or two companies, potentially 3 if we remove them. Or how many is this? 1, 2, 3, 4, 5, 6, 7, 8, 9. So 10 is what we potentially would want to aim for in total. If we remove Fuel Cell, we would need 2 new companies that we might want to add in here. And we could go the index route. We could go the ETF route as well. Those are our options. Doesn't have to be an actual, single company, a stock. So, hey, something to consider, something I figured I'd throw out there. Maybe you guys have some good plays, some good growth stocks that you like. You know what? Maybe Ace would appreciate this. Let me know. Comment down below if you have any recommendations. Otherwise, aside from Fuel Cell, we're going to continue to ride out with everyone in here. I mean, Bakkt might be the one other company that's kind of, it's iffy, has to prove itself more, and is kind of, I would say, the least kind of reliable company in here in terms of having a product that I believe is going to actually succeed and do well. So it would be those 2 companies, but otherwise everyone else in here, I'm 110% behind. I'm still big behind Bakkt. I still believe, I'm optimistic. It's early on with them. So you got to be careful. Everyone else in here, I feel good about, despite us being down quite a bit. So don't be discouraged. Remember, it's a marathon, not a sprint. Don't look at these little, these dips. When you're in here on the day to day and month, you see, oh, we're going down, we're down, it's horrible. But when you pull out, you can see, hey, we were down here when we started this portfolio. Of course, it was only $100, but you get my point. It's all about a marathon. It's about the holistic view, pulling out and looking out from the like up above and seeing the whole picture instead of just zooming in, looking at where we are today, right now, at this exact moment, because things aren't so hot. But taking this dollar cost averaging approach is a effective solution that allows us to benefit from the current circumstances that we're dealing with in the market. So I'm going to wrap it up there. I hope you guys found this video helpful, motivational, encouraging. Definitely smash that like button if so. And while you're down there, don't forget to hit the subscribe button and the notification bell so you can stay up to date on all of our latest and upcoming video content. But all right, my friends, much appreciation for watching. But you already know I gotta keep it moving. But I'll see you in the next video. Peace.